Today in this video I am analyzing companies which are into pharmaceutical sector like Cipla, Dr. Reddy's, Sun Pharma, Torrent Pharma and Biocon. All these companies' results are up to date till June 2019. Only Sun Pharma's result is up till March 2019. Let us look at the fall of these scripts from their 52 weeks high or from where the price was 1 year back. The highest fall was seen for Sun Pharma at 38% from where the price was 1 year back. Even Biocon has seen a 36% drop from its 52 weeks high. The other three companies have a reasonable fall of the lowest fall was seen for Dr. Reddy at 13%, Torrent Pharma fell by 15%, and Cipla saw a fall of 29%. So any fall of more than 30% would be considered bad. A fall of 38% would create an opportunity to buy into Sun Pharma and Biocon if all the ratios are intact. Next, let us look at the earnings yield. That is on the price, what was the profit earned by the company. The highest earnings yield was seen for Cipla and Dr. Reddy's at 5% and Cipla at 4%. That is on a price of 2,500 for Dr. Reddy's Lab. The company earned 129 rupees, a 5% earnings per share. Cipla earned 4%. The lowest earnings yield was seen for Sun Pharma at 2.6% and Torrent Pharma at 1.7%. That is on a price of 1,675 for Torrent Pharma. The profit per share or earning per share was just 28 rupees. Biocon's earnings yield was 3.7%. So here we want the earnings yield to be as high as possible. Next, let us look at the price to earnings ratio. That is how far away the price is compared to the earnings per share. This is exactly opposite of the earnings yield. The price to earnings ratio or P ratio helps us understand what is the multiple between the price and the earnings per share, or how much investors are paying more for the earnings of the company. Cipla's earnings per share was about 25 times, which is my benchmark. Even Sun Pharma's, Torrent Pharma and Biocon, all three were above 25 times. The highest price to earnings ratio was for Torrent Pharma at 36 times, meaning for an earnings of 28 rupees per share, investors were willing to pay 1,675 rupees. Biocon's multiple was 33 times, that is on a earnings of 8.4 rupees per share, investors were willing to pay 228 rupees per share. The best earnings price to earnings ratio was seen for Dr. Reddy's at 19.9 times, which is below 25. For the earnings of 129, investors were paying 2,573. That is a multiple of 19 times. Cipla's earnings multiple was very near to 25 times. On an earnings per share of 19 rupees, the price of the share was 485. That is a multiple of 25 times the earnings. So here we don't want to pay more than 25 times and as low as possible. Next, let us compare the current price earning multiple we paid against its 5 years average and 3 years historical price earning. That is how the current price earning multiple is comparing against its historical 5 years average price earning and 3 years average price earning. Cipla and Dr. Reddy price earning multiple has fallen below its 5 and 3 years historical price earnings. So that's a good point. Although this is slightly high or slightly above the benchmark, it has fallen from its historical average quite a bit. Doctors Dr. Reddy's Lab's historical 5 years price earning was 27 times. That is, throughout the 5 years on average, the price was quoting 27.9 times higher than the earnings, and in the recent price earning multiple, we're getting it at 19.9 times, which is below its 5 and 3 years average, as well as below 25 times. So this is the only company which has managed to satisfy both the criterias. Sun Pharma's price earning multiple was high at 27 times, although it has fallen below its historical price earning of 42 times and 41 times of 3 years. This is still very high. Even Torrent Pharma's historically has been very high at 31.6 and 37 times, and the recent price earning multiple is even higher than its 5 years average. So we'll definitely would want to wait before we buy into this company. Biocon's current price earning multiple was 33 times, below its both 3 and 5 years average, and above the 25 times. So this is also very expensive. Next, let us look at where the price is compared to the operating cash flow of the company. The operating cash flow is calculated using all cash inflows and outflows out of the operations of the company. We are not considering cash inflows and outflows out of the investment and financing activity. Whereas earnings per share calculates all expenses and incomes, whether received in cash or not. Regardless of that, the net profit is calculated. Whereas in operating cash flow, as I mentioned, only cash inflows and outflows out of the operating activity of the business is considered here. Here too, we don't want to pay more than 25 times its operating cash flow. Most of these companies have below 25 times price to OCF ratio. The lowest price to OCF multiple was seen for Dr. Reddy's at 14.9 times. That is, price was quoting at 14 times or 15 times approximately its operating cash flow. Torrent Pharma's price to OCF was available at 15 times, which is again good. And Cipla and Biocon both are slightly near the benchmark of 25 times. The most expensive in terms of free cash flow to price was Sun Pharma, quoting at 46 times its OCF. It's very expensive. Next, let us look at where the price was compared to the company's free cash flow. Free cash flow is calculated by removing investments or cash investments done in buying of assets from the operating cash flow. Here too, we don't want to buy a company's shares when it is quoting more than 25 times. In this case, only Dr. Reddy and Torrent Pharma had a good price to free cash flow multiple of 19 and 24.9 times. Cipla's price to free cash flow was quite high at 32.9 times, and Sun Pharma and Biocon both had negative free cash flows, price to free cash flow ratio. This happens when the company is investing more than what it has earned through operating activities and investing more than what it has earned in the recent year of 2019. Biocon has utilized almost all of its cash earned through operations into investing into buying of fixed assets or assets. Next, we'll compare the price with the book value, that is how far away the price was compared to the actual value of the share as per the company's records. Most of these ratios I've covered in all my previous videos. Here I'm going a little quickly because if someone wants to understand these ratios better, they can refer to the old videos where I've explained in detail each ratios. Here too, we don't want to pay more than 2.5 times the book value. So if the book value is per share is say 100 rupees, we don't want to pay more than 250 rupees for that share, or a multiple of 2.5 times. Most of these companies were trading at above 2.5 times its book value, which is quite high for me. My benchmark is that I should buy a share when its price to book value is below 2.5. In this case, only Sun Pharma's book value has come down very near to the benchmark of 2.5. Rest all of these companies are expensive. Cipla is very near to 2.5. So next, if it does fall, we can consider this. Next, we'll look at where the price is compared to the sales the company has done. We can also look at it in this way. What is the market cap and what is the sales of the company in the recent year? So if the market cap is very near to the sales, it is considered that we are buying at a reasonable level. But if the price is way higher, that is market cap is way higher than the total sales done by the company, then we are buying expensive. Cipla's market cap was quoting at 2.4 times more than the sales. So here we want it to be as near to 1 as possible. That is, the market cap and the value of the sales is almost equal. So we are buying at a reasonable level. Dr. Reddy is quoting at 2.8 times its sales. Sun Pharma's entire market cap is 3.5 times more than the sales. So the higher, the more expensive we are buying. Biocon is trading at 4.7 times its sales. The entire market cap valued by the investors is 4.7 times more than the sales the company managed to do in 2019. As I mentioned, we want to buy as low as possible. There is no fixed criteria here, but as near to 1 as possible. Next, let us look at how the profit has been growing compounded over the last 5 years and over the last 3 years. Cipla has seen a very mild growth of 0.2% over a period of 5 years and 2.4% over a recent 3 years. This is very low. My benchmark is 10% growth rate in profit year on year from both 5 and 3 years. Dr. Reddy's profits of the last 5 years has seen a fall of minus 1.4%, and in the recent 3 years it has seen a further decrease or further degrowth in profit by 4.4%. So this is not good. Sun Pharma's profits for both 5 and 3 years have seen a high degrowth of 6% and 10%. That is, the profits have been decreasing at the rate of 6% since last 5 years on a compounded basis. Torrent Pharma also has seen a fall in its profit by 2% since last 5 years and 31% since last 3 years. So the highest fall in profit was seen for Torrent Pharma over a period of last 3 years. Biocon has seen the best growth rates for both 5 and 3 years. Since last 5 years, Biocon's profits have been growing at 12%, and in the recent 3 years it has further increased to 28% year on year. So the best values were available for Biocon. its profits are growing at the highest pace. Next, let us look at the price earnings to growth ratio. This is calculated by dividing the recent price earning ratio we calculated earlier and dividing that by the profit growth rate of 5 years, which we saw in the previous graph. So what we get here is the price earning multiple we paid for the stock. What is the earnings growth we are getting in that particular company? So even if we pay a high multiple of say more than 25 times, but if we are getting a high growth rate in profit as well, then that is considered much better than just buying a price earning of low multiple and not getting any profit growth rate. This we'll understand through these graphs. Cipla's price earning multiple investors were paying was 25 times in the recent year, but the growth rate in that earning was just 0.2%. That is, we are dividing 25 by 0.2, so we get 125. So for my benchmark, I want the PEG to be below 1.5 and above 0. Dr. Reddy's, we saw earlier that we are paying the lowest price earning multiple of 19.9 times. But again, in the recent 5 years, we have seen a fall of minus 1.4% in its profit. So even though we are paying a very low price earning multiple, we are not getting any growth rate in that earning. So it will take us more than 19 years of these profits because to recover our capital. So we want to see a profit growth rate which is as good as the price earning multiple that we are paying, so that we can recover our initial investment much faster. Sun Pharma's price earning multiple was 27. Although investors were paying 27.7 times more than the earnings saw a fall of minus 6% since last 5 years. So this has done much worse. So we're getting a PEG of minus 6.4. So in this case, Dr. Reddy is done much better than Sun Pharma. Torrent Pharma's price earning multiple was 36 times, and again a degrowth in profit of 2%, which is a PEG of minus 29. Biocon has seen the best multiple, although in compared to other companies, Biocon has done the best, where although we are paying 33 times, we are getting a growth rate of 12%, much better than paying for Dr. Reddy's Lab of 19 times and not getting any growth, in fact finding a degrowth in its profit. So here at least we'll be able to recover much faster than what we can recover in Dr. Reddy's. So Biocon in this particular PEG analysis has done the best, although it is above my benchmark of 1.5. Next, we'll compare the recent price earning with the profit growth of the recent 3 years and try to understand how the PEG has turned up in the recent 3 years. Cipla, we paid 25.1 times the earnings, and we saw in the recent year that there was a mild growth in the earnings of 2.4%, which is a PEG of 10.7. Again, a very high value. Dr. Reddy's Labs paid 19 times the lowest price earning multiple again, but in the 3 years we are not getting that growth rate that we are looking for. So again we saw a degrowth in the recent 3 years of 4.4%, which translates to a PEG of 4.6. Sun Pharma paid 27 times but no growth at all, again a negative value of minus 3.8. Not a good price earning multiple to pay at all. For Torrent Pharma, 36 times we are paying and no growth at all. In fact, a fall in its profit in the recent 3 years of 31%. A PEG of minus 1.9. Biocon has seen the best PEG of 1, where the price earning multiple we paid was 33 times, but we are getting a very high growth rate in its profit of 28%. So it is much better to pay 33 times than pay 19 times for Dr. Reddy's and get no growth. Here at least we are getting a good growth rate in profit, for which we are paying 33 times more. So after looking at price earning multiple, we should not just think that because the price earning multiple is low, that is the best value. We also have to look at what is the growth in that earning for which we are paying this multiple. Next, we'll look at the growth in sales compounded over the last 5 years and growth in sales over the last 3 years. Here too, I want the sales to be growing at least 10% year on year, which would then suggest that the company's management is doing something correct so that the sales has been growing consistently at 10% and above. In the recent 5 years, Cipla has managed a growth rate of exactly 10% in its sales, whereas in the recent 3 years, it has seen a decrease in that growth by almost half. Dr. Reddy's Labs has not seen any growth in its sales since last 5 years. The growth rate is just 2.9%, and in the recent 3 years, it has seen a degrowth in its sales of minus 0.3%. So this is not good at all. Sun Pharma's sales has been increasing at 12%. That's a good value. But in the recent 3 years, we have seen a moderation or very low sales growth of 0.7, even less than 1%. Here what we want to do is we want to see a growth rate of 12% in 5 years and a further growth rate in the recent 3 years. That shows strength, like in Biocon, where in the last 5 years the sales was growing at 13%, and in the recent 3 years it has picked up much faster, and the sales is further growing at 18% now in the recent 3 years. So this is the best value for Biocon. Torrent Pharma, last 5 years sales were growing at 13%. In the recent 3 years it has seen a moderation or a drop in its sales by the growth was in fact 4.7% in the recent 3 years. Next, let us look at the return on equity, that is, what is the net profit the company has generated on the investments done by the shareholders of the company. We'll first understand what is the 5 years average return on equity. Here we want the profits to be generated on shareholders' money to be at least 15% for both 5 years average as well as the recent year of 2019. Anything below 15% is not a good value. All of these companies have seen a very low return on shareholders' money. Cipla 5 years average was 9.9, and in the recent year of 2019 return on equity was just 9.6, even below its 5 years average. Dr. Reddy's profits on the shareholders' money was 14.3% on average, very near to the benchmark, and in the recent 3 years it has seen a fall to 13.6%, again below average. Even Sun Pharma has seen a fall in its recent RoE to 9.2% from its 5 years average. Torrent Pharma, last 5 years average was 25.7, but in the recent year it has not been able to sustain that profit generated on the equity. Even Biocon's RoE were very weak at 11% on average for the last 5 years and 12.9% in the recent year, although it has seen a slight growth in its return on equity over its 5 years average. So most of these companies have not managed a good return on equity for the shareholders. Next, we'll look at the return on capital employed. The capital employed in this case is calculated, or the capital employed in this case is considered by adding fixed assets of the company with the working capital, and we take the average of 2 years and divide that by the EBIT, or EBIT is divided by the average fixed assets plus working capital. In this case, what we are trying to understand is how much earnings the company generated before considering the interest and tax on the total fixed assets of the company, and current assets minus current liabilities, that is the working capital. So this way we can understand how each company is comparing, or what is the return they are generating when we consider these assets. Some people also utilize net worth plus borrowings against the EBIT as return on capital employed, but in this case I've considered fixed assets and working capital. Here too I want the returns to be generated to be more than 15%. None of these companies have managed to generate more than 15% except Sun Pharma. Over its 5 years average, return on capital employed was slightly above 15%, and Torrent Pharma managed a 21% return on capital employed over a period of 5 years. For the all other companies, for both 5 years average as well as recent RoCE were below 15 times. Return on assets of the last 5 years. In this case, the assets I'm considering is the total assets of the company, everything, and we remove that. Out of that we remove the current liabilities, which is not considered as an asset of the company, although we use current liabilities in the company to generate returns. But in this case I'm removing it out because this is not the asset the company owns. It owes it back and it has to pay that current liabilities. And we are considering return as the net profit in this case. So on the total assets employed less the current liabilities, what is the profit or net profit the company is generating? Here there's no benchmark as such, but whatever the highest the company is able to generate, we should look for that. All three companies, Dr. Reddy's, Sun Pharma and Torrent Pharma, have managed to generate above 10% of return on assets. That is, their net profits were more than 10% on the total assets of the company, which is a good value to consider. Biocon has seen the lowest return on its assets, and Cipla has seen a 7.6% of profit on the total assets of the company. In asset turnover, we are trying to understand what is the multiple times the assets were converted into sales. Again, here the assets in this case is the net worth of the company, that is the equity plus the reserves and the borrowings. These three things we consider as funds received by the company or assets of the company on which it is generating annual sales. So we are trying to understand whatever assets were employed into the business, against that what was the sales the company managed to do. Here we want the multiple to be more than 1 times at least. Both Cipla and Dr. Reddy's asset turnover was very near to 1 at 0.9 times. The other three companies, Sun Pharma, managed just 0.6 times its assets employed. So it shows efficiency. If the company is managing more sales than the assets employed into the business, that shows that the company is doing something correct to increase or use that particular capital to generate higher and higher sales. Torrent Pharma and both Biocon have seen 0.7 times the assets employed into the business. Next, let us look at the conversion of profit into cash. That is, how much of the profit the company showed has actually been received in cash by the company. Many times we see that the profits shown by the company is 100 CR, for example, but the actual cash coming in into the company maybe just 50 CR or 50 crores against the 100 crores of profit. So we don't want to see these kind of ratios where the cash coming in is less than the profit. All of these companies' conversion of profit into cash has been very good. The highest conversion was seen by both Torrent Pharma and Dr. Reddy's. I'll explain this. The cash for Torrent Pharma, or the profit for Torrent Pharma over the last 5 years was 4,686 CR. Against that, the company's cash coming in was through operations was 7,253. That is, it has received more cash than what it showed as profit. The reason for the difference between the two is the non-cash expenses which are added back in the cash flow from operations. I'll explain this further. Let us say in this profit, we know that the company has reduced depreciation expenses, which is a non-cash expense, or it may have reduced some extraordinary item or an exceptional item or some write-offs. So those are non-cash expenses, and when we calculate the cash from operations, we add those expenses which were removed from the profit after tax. We add it back in the cash flow from operations. So we see a higher value of the cash. So we do want to see a higher value than the profit after tax. Dr. Reddy's Labs has received 51% more than the profit of the last 5 years. That is, over the 5 years, the profit was 8,300 CR, against which the company's cash flow from operations was 12,604 CR. Very good values. Even Cipla has managed a 38% growth over its profit in terms of earnings cash. The lowest multiple or percentage growth in cash coming in against the profit was for Sun Pharma, where its profits were 22,000 CR and its cash coming in was 25,400 CR, an 11% increase from the profit after tax. So here there's no fixed benchmark, but we can look at a positive value. Even if it's more than 1%, that's good, but it has to be positive. Many times we see that the company's profits are not getting converted into cash, and we'll see a negative value here. So that will be considered not good. Next, let us understand how much of this cash earned through the operation has been used in buying of assets, and how much is left over as free cash flow to be used in the financing activity of the business, like buying or doing acquisition or doing buyback or paying bonus or dividend to the shareholders or paying off the loans. Cipla cash flow was 8,450 CR over the period of last 5 years, and its free cash flows were 4,430 CR. That is, the balance of the two was used in buying assets, which is 48%. So I don't want the companies to spend a lot of their cash from operations into investing in fixed assets. There has to be a limit into how much they are investing in assets and how much they are using it to pay off the loans, or if they have any, or pay off or pay dividend or do acquisition and so on. We don't want too much of cash earned through operations to be used up. So this is a good value. For my benchmark, I don't want it to fall below 50%. Dr. Reddy's has also managed to keep its investments in fixed assets at 45%. It still has a free cash flow of 6,900 CR against the cash earned of 12,000. Sun Pharma has managed is slightly going, it has just gone slightly above the 50%. So I've still given it a positive value. It earned a cash of 25,000 against which it still had 11,000 left over as free cash flow, and 56% was utilized in buying assets. Torrent Pharma has also seen a 38% use of cash into assets. Biocon cash was 3,038 CR, but as I mentioned earlier, the company's investments in assets were more than what it earned through operations. Not only has it spent the entire 3,000 CR into buying fixed assets, but it has spent over and above that 1,430 CR into these assets. So we don't want to see these kind of values for companies where they're investing more than what they are earning through operations. This is possible to do if over and above spending all this cash, they borrow loans from the banks. But then once they start borrowing, they have to also repay interest on that. That basically increases the burden on the company, and that affects the net profit. Next, let us compare the current year's or the latest year's profit and look at how much of that profit has got converted into cash. Like in 5 years, here we are considering only the recent 2019 data of the PAT and the cash. Has the company managed to convert all of its profit into cash or not? All of these companies' current year's conversion of profit into cash was good. The highest conversion was seen for Torrent Pharma at 202% against its net profit. That is, the net profit was 596 CR in the recent 12 trailing months, or rather in 2019, against which the cash coming in was 1,798 CR, a 202% jump over its profit, which is a good sign. Biocon saw a growth in its cash from operations by 59%. Over the 5 years we saw earlier that only Biocon's cash from operations was negative, but in the recent 2019 its cash has come in against the profit. Sun Pharma's recent years cash from operations has fallen below its profit. Most of the profit that the company has shown of 3,600 has not come into the company as cash. In fact, it has fallen short by 40%. So we don't want to see these kind of values over a long period of 5 years, like in Biocon. So 1 year it's okay, maybe next year it can recover this back. Dr. Reddy has seen a 58% up move against the profit of the latest year of 2019, and it has got converted into cash. So we want to see a value, positive value, and as high as possible, so that it basically tells us that most of the profit, against most of the profit, the cash has actually come into the business. Next, we'll compare the current year's profit or 12 trailing months profit. This is the profit of the latest 12 months or latest 4 quarters, whichever is available. And this profit value is not of the 2019, but of the recent 12 trailing months or recent 12 months. And we'll compare this with its last 5 years average. So we'll understand how the current year's profit or the 12 months profit has panned out against its average. Cipla's current 12 months profit is 27% more than its 5 years average. So this is a good value. So we want to see a profit of the 12 months to be above its 5 years average and as high as possible. That would show strength. Sun Pharma's recent profit of the 12 months has fallen below its 5 years average of 4,600 CR. That is a 20% fall. Even Torrent Pharma has seen a 16% fall in profit over its 5 years average. Biocon has seen a good growth rate in its profit from its 5 years average. Its 5 years average profit was 484 CR, whereas the whereas the recent 12 months profit is above its 5 years average profit. Next, we'll look at the profit growth year on year, that is from 2018 to 2019, how has the profit grown. So we want a good growth rate of more than 10% in profit. Cipla has seen a 5% growth rate from 2018 to 2019 in profit. Although I've given it a positive sign, it should be considered a negative value because my benchmark is 10%. Dr. Reddy's has seen an 103% jump over its previous year, and all these profit values excludes any extraordinary items in the P&L account. So that needs to be considered while looking at these graphs. Sun Pharma has seen a 31% increase in profit of the 2019 against profit of 2018. Torrent Pharma has seen a fall in its profit, a mild drop from its previous year. Biocon has seen a jump in its profit from 2018 by 121%. Next, let us analyze the quarterly YoY sales and profit growth rate. This is the comparison of June quarter of 2019 with June quarter of 2018 for all of these companies except Sun Pharma Industries, where we are considering March 19 quarter with March 18 quarter. Here we want the sales and the profits to be growing at least 10% and above. Cipla's sales and profit YoY has not seen a great increase. In fact, the sales has increased by just 1% over its previous quarter, and the profit has grown by just 6%. Dr. Reddy's sales has grown by just 3%, but the profit has seen a high growth of 42%. Sun Pharma has seen a growth in sales of 3% but a drop in profit of 53%, a very high drop in its profit from where it was in the previous quarter of March 2018. Torrent Pharma has seen an 8% growth rate in sales but a high growth rate in profit of 33%. So this should be considered overall good. But the highest growth in sales and profit was for Biocon. Its sales has grown up by 30% and the profit has shot up to 72% over its previous year's quarter. Next, let us look at the sequential quarter-on-quarter analysis of sales and profit. Here we are comparing March 19 quarter with June 2019 quarter. Sales has seen a fall by 9% and profit has gone up by 30%. Dr. Reddy's sales has fallen by 4% and has seen a growth in profit by 49% over its previous quarter. Sun Pharma has seen a fall in both the sales and the profit. Torrent Pharma has seen a growth in its sales quarter on quarter by 9%, but a fall in its profit by 242%, a very high fall in its profits of where it was in the previous quarter. Biocon has seen a mild drop in both the sales and profit of 4% and 3% each. Here too, I would want a growth rate of more than 10% in both sales and the profit. Next, let us look at what was the contingent liability of these companies against their net worth. Here, I'm just trying to understand contingent liability is within the reasonable range of 20% against the net worth or not. Here, I don't want the contingent liability to exceed 20% of the net worth, because contingent liability is a liability which is not shown in the balance sheet but is shown as a footnote or note to the balance sheet, to the financial statements. So this is a risk that the company has not shown in their financial statements. For me, I don't want the contingent liability to exceed 20% of the net worth. Net worth is basically the actual value or worth of the company after paying off all the liabilities it owes, and by selling all the asset that it owns. The highest net worth was seen for Sun Pharma at 41,000 CR. This is the actual value of the company after paying all liabilities. Even Cipla and Dr. Reddy were at 15,000 and 14,000 CR. Torrent, Pharma and Biocon have seen a low net worth of 6,300 and 4,700 CR each. Against these net worth, what was the contingent liability? Most of these companies have seen low contingent liability. Sun Pharma's contingent liability is nearing 17%. That is, on 41,000, its liabilities were 7,200. It's nearing my 20% benchmark. Biocon is at 13% its net worth. Its contingent liability was 811 CR against the net worth of 6398. So we don't want a very high contingent liability for the companies. Next, let us look at the debt to equity ratio and also look at where the profit was compared to the borrowings, or how much was the borrowings against the profit of the company. And then we'll look at the interest coverage, which would be a comparison of earnings before interest and tax with the actual finance cost. That is, what was the multiple of EBIT and the finance cost, or in other words, how much more were we paying as finance cost against the EBIT of the company. All these three ratios are very important to look at. The company's debt to equity for Cipla was 0.3. My benchmark is that the debt should not exceed 1 times of the equity. Whenever the borrowings of the company exceed the equity contribution done by the shareholders, that would basically mean there would be more burden on the company to pay interest to the banks from where it has taken these borrowings, and that affects the net profit and the return ratios of the shareholders. Cipla, Dr. Reddy, Sun Pharma and Biocon, all of them had a reasonable debt against the equity of less than 0.4. So this is good. Against the debt to profit, here what we are trying to understand is, using the profit of the current year, how many times more was the borrowings. Cipla's borrowings were 2.8 times more than the profit. So if it has to pay off all its debt or borrowings using the current year's profit, it will take it 2.8 years to pay off its entire debt. So this is a good value. We don't want a very high debt to profit ratio. Its EBIT, earnings before interest and tax, is 12.4 times higher than what it paid as finance cost. So its EBIT is enough to cover finance cost of the next 12 years. Dr. Reddy's Labs also had a good ratio for all of these three. Its debt to equity was 0.3. its borrowings were 2 times more than the profit of the current year, and its EBIT was 27 times more than the interest it paid. Sun Pharma's debt was 0.3 times, and its borrowings or total debt was 3.9 times more than the profit. So it will take around 4 years to pay off its entire debt using the current year's profit. That is, if we consider the current year's profit will keep constant, then it will take 4 years to pay off that entire borrowings. Its earnings before interest and tax or EBIT was 10 times higher than the finance cost. So this is also good. All values are good. Torrent Pharma has seen all the 3 values go below the benchmark. First of all, its debt was 1.3 times its equity, which is high, which is above my benchmark. And its profits would take 13 years to pay off the entire debt. So its borrowings, we can say, was 13 times more than the current year's profit, which is high again. And its coverage has fallen below 4 times, which is my benchmark. That is, the finance cost, or rather the earnings before interest and tax, was only around 3 times more than what it paid as finance cost. So the ratio between the two of them was 3:1. So if it paid 1 as interest, then its earnings before interest and tax was 3, or rather 2.9. Biocon's values were all okay. Its debt was slightly high at 0.4. Its borrowings was at 2.7 times more than the profit of the 2019, and its EBIT was 17.4 times more than the interest it paid. So all these numbers are okay. All the companies have managed good multiples for these ratios except by Torrent Pharma. Next, let us look at the promoter holding and pledged shares, if any. Promoter holding is the total shareholding of the promoters of the company. Here we don't want the promoter holding to fall below 30%. Some of the companies may not have any promoter holding at all. That is okay. But for companies which have promoters, we want it to be as high as possible. That would basically suggest that the company's promoters have a high stake in running the company in a profitable manner, so that not only they get the value from that company, but the shareholders will also gain along with that. The pledged shares should be less than 20% if there is a pledge against the promoter holding. We don't want a very high pledge of shares against the promoter's holding, because if the pledged shares are not removed from the banks, or the money is not paid to the bank against the pledged shares, those shares will be sold off in the open market by these institutions, which would affect the price. All of these companies' pledged shares were below 20% of the promoter holding. In fact, none of these companies had any pledge of their shares except Sun Pharma, whose promoters have pledged 11% of their holdings of 54%. Dr. Reddy's promoters holding has fallen below 30%, and the highest promoter holding was seen for Torrent Pharma and Biocon. The promoters have very high stake in the company. Next, let us look at what was the debtor's position against the sales of the company. That is, how much payment was still to be collected from the customers against the current year's sales, and whatever was to be collected, how many days is it taking to collect from these customers, or how many days the company is giving the customers to pay them back. We'll also look at what was the debtor days or collection days 3 years back. Cipla's debtors were around 25% of the current year's sales, meaning 25% of this year's sales was still to be collected from the customers. Here I don't want the debtors to sales percentage to go beyond 30%. Sun Pharma has seen crossing the benchmark of 30%. It has just gone slightly above 30.6. That is 30% of this year's sales was still pending to be collected from the customers. Not only that, it is taking a very high number of days to collect that payment from the customers. It is giving 112 days to the customers to pay back to the company. My benchmark is 90 days or less than 90 days. Max to max, the customer should be paying back the company within 3 months. Cipla's collection days were also high, crossing above the 90, which is my benchmark. Dr. Reddy's was taking 94 and 97 days in the current year and in 3 years back. So here also it has exceeded the 90 days collection period. Sun Pharma 3 years back was collecting in 87 days, but in the recent year of 2019, the collection days has increased further to 112, which is not a good sign. Cipla was collecting in 62 days, now it has increased to 93 days. So there is some pressure on these companies because of which they are not able to collect faster and they have to give more credit to the customers. Torrent Pharma's collection days has decreased from where it was 3 years back. 3 years back it was taking 79 days, and in the recent 2019 it's taking only 68 days to collect. Not only that, the amount to be collected from the customers against the current year sales is just 18%, the lowest in the peer group. Biocon's collection days is also below 90, and the collection to be done against the sales was just 22%. Next, let us look at how the inventory of the company was converted into sales. What was the multiple between the sales and the inventory? So the higher the inventory turnover into sales, the better it is. And we'll compare this current year's inventory turnover with its 3 years back value. Cipla's inventory of 2019 in the balance sheet was, or rather the sales was 4 times higher than the inventory holdings. 4 times more than what the company was holding as inventory has been turned over into sales. 3 years back it was 4 times, so it is very near. We want to see a trend, a value which is very nearby to each other, or there is a further growth in the current turnover. Dr. Reddy's had turned over its inventory by 4.9 times into sales. 3 years back, the inventory turnover was higher at 5.3 times. So it has fallen below its where how fast it was converting 3 years back. Sun Pharma inventory was the lowest at 3.9 times. In fact, Torrent Pharma should also be given a negative at 3.9 because the inventory compared with the other group companies is quite low. This ratio cannot be completely depended upon because if the inventory holding is less, then also the multiple will shoot up. But most of these companies will be in a particular range. Whenever we see a high divergence from the range, it either means that the inventory holding in the balance sheet is low or the sales against that is quite high. Torrent Pharma was converting its inventory into sales by 4 times 3 years back. The highest turnover was seen for Biocon at 6.3 times and 6.6 times. Next, let us look at the average operating profit margin these companies have earned over the 5 years period on average. I want the OPM to be at least above 15% so that we can deduct other expenses from that and still have a good NPM value of 10% and more. Cipla's 5 years average operating profit margin was at 18%, above the 15% benchmark, which is good, but it could not give a double digit net profit margin. Its 2019 net profit margin was 9.3%, slight below our benchmark of 10%. Even in 2018, its NPM was 9.3%. Dr. Reddy's Lab has seen an OPM of 20%, and the recent years net profit margin was 12.6%. But in 2018, the NPM had fallen to 6.6%. Sun Pharma's operating profit margin was very high at 26.4%, yet couldn't sustain the net profit margin above 10%. In fact, in 2018, the net profit margin was even lower at 7.9%. So there is definitely either a high depreciation cost, which is reducing the net profit margin, or a high interest cost. Torrent Pharma NPM was very good at 27.2% of the last 5 years, but in the recent year of 2019, its net margin was just 5.7%, whereas in 2018 it was 11.4%. So this has worsened in 2019. Biocon has seen a 22% 5 years OPM and 16.4% net profit margin in 2019, way above the margin earned in 2018. So the company has done well in generating a higher margin against the sales. Next, let us look at the liquidity position of the companies. How quickly can it pay off its current liabilities or liabilities it has to pay in the current year against the current asset it holds. All of these companies' liquidity position is very good. The highest liquidity position was seen for Sun Pharma, whose assets were 3.3 times more than the liability it had to pay. Even Cipla had a good current ratio. Here we want it to be more than 1 times for both current ratio and quick ratio. Next, let us compare the total gross block of the company. This is the assets that the company has on its balance sheet at its acquisition cost. That is the total value of the asset the company still has, excluding the accumulated depreciation. So, to give you an example, this 31,000 CR assets that the company has, this is the total assets of the company till date at its acquisition cost or at the cost price. Out of this 31,000 CR for Sun Pharma, the company has already depreciated assets of 9,851 CR till date. So now the balance only it has to depreciate to the P&L account. So we have the total accumulated depreciation of 31%. So more 70% of the asset needs to be depreciated or expensed out to the P&L account in the future years. So here we want the accumulated depreciation percentage to be as high as possible. The highest accumulated depreciation was seen for Dr. Reddy's Labs at 60%. That is, out of 18,000 CR of gross block or assets at acquisition cost, 10,000 has already been depreciated. So now only 8,000 still needs to be expensed out to the P&L over the future years. Biocon's accumulated depreciation is 37%, and the balance of 63% needs to go to the P&L over the future years. The lowest accumulated depreciation was for Torrent Pharma at 22%. So almost 7,000 CR of assets still needs to be depreciated to the P&L account. So when we see a high value as in Dr. Reddy's at 60%, it signifies that the company's assets, most of the assets have already been depreciated in the past years, and from here on the depreciation expenses going into the P&L account will be considerably low and therefore will not affect the net profit of the company in the future years, and vice versa. Finally, let us look at how the company is depreciating its net block or net assets. Net assets is the value after we remove accumulated depreciation from the gross block. That is, whatever company's assets were at its acquisition cost, of that we remove the already depreciation which has taken place, and what we get is the net block. And on that net block, what is the depreciation rate being charged by the company? Cipla's net assets after removing accumulated depreciation was 9,600 CR. So this asset it still owns, on which it needs to depreciate every year. So it is depreciating at 14%. So we want the depreciation rate also to be as high as possible, so that the company is not manipulating the profit. So the higher the depreciation rate, the lower the profit. Dr. Reddy is also depreciating its assets at 16%. So in 2019, it had given an expenses to P&L account of 1,100 CR. Cipla had given an expenses of 1,326 CR to its P&L account. Both Sun Pharma and Torrent Pharma both were depreciating at a very low rate of 8%. So what happens is, out of this 21,000 CR assets, 1,700 was sent to the P&L, and the balance will be going to the P&L in the future years. So the expense is always there or will always be there in the future years. Same is the case for Torrent Pharma. So we want the depreciation rate to be as high as possible. So this concludes my analysis in the graph section. We'll move back to the Excel sheet, and I will give all these ratios a score from -5 to 5, and whichever ratios are not in my benchmark, they will get the negative scoring, and the ratios which have the best values will get the highest score. I've given the scores and the ranking to each ratio for all of these companies. I will not go into each individual ratios again, but if you want to look at these ratios, I will pause the screen for say 5 seconds. You can go through these ratios. So after putting all these scores and giving rank to each ratios, I can conclude that the first or the highest points for all the ratios was received by Biocon, The total score it received was 128 points. Dr. Reddy received 118 points, the second highest. So the more the points, the better it is. Torrent Pharma received 95, third highest, followed by Cipla at 86 points. Sun Pharma received the lowest points at 35. Let us look at how these companies have done individually in terms of ratios. I have grouped these ratios into different metrics. Efficiency covers asset turnover, or how efficiently it is turning over its assets into sales, how well it managed its contingent liability, what was its debt against the equity, what was the EBIT against the finance cost or interest paid, and so on. For all of these ratios, I've included them in the efficiency metric. In the cash flow metric, I've included how efficiently the companies have converted profit into cash and how much of the free cash flow is still left out of the cash earned through operations. In the growth metrics, I'm looking at sales growth, profit growth over the period of 5 and 3 years. How is the ROE growing over the period of 5 years? How is the profit growing above its 5 years average? And so on, like quarter on quarter, year on year. In solvency metric, I'm looking at promoter shareholding, if they have pledged anything, the liquidity position like current ratio and quick ratio. In the written metrics, I'm looking at the profitability ratio, that is how much profit the company was earning against different variables like equity, capital employed, assets, invested capital, operating profit margin, NPM, and so on. In valuation metric, I'm looking at price to earnings multiple of the recent months, 5 years average, 3 years average. Where was the price against the OCF, the free cash flow, the book value, how far away the market cap was against the sales of the company, the PEGs of both 5 and 3 years. All these are included in the valuation metric. I've given them the weightage according to the importance that these metrics mean for me. For me, efficiency is very important, so I've given it 6 points. So even after putting all the points and all the scores, we find in terms of efficiency, Dr. Reddy and Biocon have done the best in basically managing its different variables or different assets efficiently. Sun Pharma's efficiency ratio was very low at just 14 points in total. In terms of cash flow, Dr. Reddy and Torrent Pharma both have converted their profits into cash in the most efficient manner. Sun Pharma has seen the lowest cash flow conversion against the profit earned. In terms of growth metric, only Biocon has seen high growth in terms of sales and profit growth. All of the 4 companies have seen very low sales and profit growth rates. In fact, Sun Pharma has seen a negative value in its growth metrics. In terms of solvency, Dr. Reddy and Torrent Pharma have done best of managing the liquidity position and the promoter holding and so on. The worst ratio for solvency metric was against Sun Pharma. Sun Pharma has not scored good in any of these metrics. In terms of profitability metrics, the highest score was for Cipla and Sun Pharma at 16 and 14 points. The lowest profitability ratio was seen for Dr. Reddy's at just 8 points. In terms of valuation metric, the most economical or most lowest valuation metric was seen for Cipla and Dr. Reddy. Both are available at a very low valuations or price, and Sun Pharma was the most expensive with 8 points. So to conclude this, Biocon has got the first rank with highest points. Dr. Reddy has got 400 points with second rank. The Third rank was for Torrent Pharma. Fourth rank was for Cipla. And the lowest rank was for Sun Pharma at 97 points in all. This concludes my analysis of these companies. Thank you for watching this video.